Hey guys, so in this video, I'm going over 5 top dividend stocks that pay up to 8.5% in annual dividends. I spend a lot of time analyzing stocks, and these are some of the companies I recommend checking out. Make sure to watch until the end as I'll go over key numbers, current news, and my opinions on why these could be good stocks to hold. Let's get started. So the first company on my list is TC Energy, stock ticker TRP. TC Energy is a part of the transportation and warehousing sector, and they're involved in the pipeline transportation for the natural gas industry. This company operates a 60,000-mile network of natural gas pipelines. They transport natural gas from supply basins all the way to local distribution companies, power generation plants, and industrial facilities. Right now, TC Energy is trading at $44.41 with a 52-week low of $32.37 and a 52-week high of $57.92. Looking at their 1-year price chart, we can see a pretty steep drop at the beginning of the pandemic, and since then it's really hovered between $40 and $50. They do have a market cap of $41.519 billion, a PE ratio of 15.97, earnings per share of $2.78, and a pretty great dividend of 5.89%. Right now, their price to book ratio is 1.78. And if we take a look at their profitability, we can see that their profit margins are quite good, with their profit margin at 35.49%. They also have a pretty good return on equity of 14.68%. One thing that's a little bit off about this company is their balance sheet, and we can see that their current ratio is 0.51. This means they have about half the current assets as they have current liabilities. Now, it's always interesting to see what the analysts have to say. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts rate TC Energy as a 1.7, meaning it is a buy. And the average analyst price target is $54.51, which is about 20% higher than the current price of $44.41. So one reason why I think TC Energy is such an attractive stock is because pipelines do not produce oil. Instead, the more gas that they move, the more money they can actually make. So since it's not as correlated with energy commodity prices, it's more low risk for the energy sector. Now, they have increased both profits and cash flows throughout its history, despite regular shocks to the system. For example, the demand for oil during the pandemic was down a lot. However, TC was able to maintain profits that were actually equal to 2019 and grow their cash flows. For the first 3 quarters in 2020, their net income increased by $165 million all the way to $904 million. And 95% of their earnings actually come from regulated assets or assets that are backed by long-term contracts. This should equate to a more reliable dividend and share price. TC has a proven capital allocation model where 60% of its revenues are reinvested back into its business, targeting low-risk assets that increase productivity. The dividends have increased for the past 20 years, and its $30 billion of projects sitting on its books makes this an attractive stock to look into. They've also issued guidance saying that their dividends are expected to grow up to 10% in 2021. Overall, I think this is a relatively safe dividend stock that I am a big fan of. Next up on my list is ALTRIA Group, stock ticker MO. This is a company that sells and manufactures cigarettes, smokeless products, and wine in the United States. Right now, Altria is trading at $41.20 with a 52-week low of $30.95 and a 52-week high of $51.47. We saw the typical drop in their stock price with the pandemic, and since then it's been hovering between $35 and around $45. Altria's market cap is $76.567 billion, and they have a PE ratio of 107.29, which is very high. Their earnings per share right now is 38 cents, and they have a very high dividend yield of 8.37%. Their 5-year price to earnings growth ratio is 6.31, and they have a price to book ratio of 24.74. Their profit margin sits at about 3.56%, and they have a return on equity of 10.3%. Altria is sitting on total cash of $4.12 billion with a current ratio of 0.77. And in terms of what analysts are saying, they rate this as a 2.1, meaning it is a buy, and the average analyst price target is $47.79, which is almost 20% higher than the current price of $41.20. Now, smokable products are the largest segment of Altria, and revenue growth has been substantial, as well as their increase in net income in 2020. In fact, its revenue growth outpaced the subsector average of 1.1%, and revenues have increased by a staggering 4.9%. The stock has a very generous dividend yield of 8.53%, but of course, with high dividends normally comes a bit more risk. I've actually dived deep into the factors that can make Altria risky, but to be honest, I don't see too many risk factors. It's undervalued in many senses, and in my opinion, it's one of the safest stocks that is paying such a high dividend. Altria also has a 51-year dividend growth streak, as well as great long-term dependability. From 2012 to 2019, its operating cash flow went from $4 billion to almost $8 billion. And this resulted in its dividend doubling to $3.25. And in 2020, they raised their dividend once again. This shows that even in a pandemic, people are still buying tobacco. I mean, it's not like a glamorous industry to invest in, but there's no denying that it is quite safe. Tobacco companies are actually not allowed to advertise their products, so the big players like ALTRIA have a big advantage over newcomers. And you may have noticed that cigarette prices have gone up consistently. Less people smoke now, but ALTRIA is still able to grow its earnings just due to the fact that they can raise prices without an effect on demand. So yeah, definitely check out ALTRIA if you want a high-paying dividend stock. Third on my list is China Petroleum and Chemical Corp, stock ticker SNP. SNP is based out of mainland China, and they operate and engage in oil and gas operations. This company is also known as Sinopec, and they do oil and gas exploration, refining, marketing, and a lot more. So right now, SNP is trading at $50.74 with a 52-week low of $38.18 and a 52-week high of $60.81. They've actually taken quite a big hit in the last year, and after hitting a low in October, it seems like their price is steadily going up now. S&P has a market cap of $74.7 billion, a PE ratio of 5.58, which you guys is extremely low, and a very great dividend yield of 8.53%. Their 5-year PEG ratio is 7.57, and they have a price to book ratio of 0.48. The profit margin is just 1.65%, and they have a return on equity that's very low at 5.6%. Their current ratio is also under 1 at 0.92. Now, analysts currently are rating this as a 2.7, meaning it is between a buy and a hold. And the average analyst price target is $53.60, which is about 7% higher than the current price of $50.74. Now, compared to other general oil corporations such as ExxonMobil, Chevron, and BP, S&P actually performed much better, mainly due to China getting the pandemic under control in a more efficient manner. In the second half of 2021, the stock should see some rising stock prices just thanks to the distribution of vaccines and the pandemic hopefully subsiding by the second half of 2021. They definitely have a low valuation compared to other oil companies, making it quite attractive for potential returns over the next year. Now, I will say that S&P's dividend is a lot more volatile than many of the other oil companies, and it's just largely based on the financial results for the year. However, I really do think that 2020 was one of the worst years for S&P, and that it's going to get much better from here on out. So then what is in store for S&P's dividend this year? Their earnings are expected to make quite a comeback this year, which should translate into an increase in dividend yield. That is why I think China Petroleum and Chemical Corporation is a good pick for a long-term dividend stock. Fourth on my list is CISCO, stock ticker CSCO. And most people are going to be familiar with CISCO. They are a company that provides a broad range of technologies globally. Right now, CISCO is trading at $45.43 with a 52-week low of $32.40 and a 52-week high of $50.28. We saw a big dip with the pandemic, then we saw prices increase, then we saw them dip back again, and since the beginning of November, they are back up to about $45 per share. CISCO has a market cap of $191.965 billion, a PE ratio of 18.39, earnings per share of $2.47, and a dividend yield of 3.19%, meaning it is a mild dividend stock. They have a 5-year PEG ratio of 2.96 and a price to book ratio of 4.96. Their profit margin right now is sitting at 21.76%, and they have a very good return on equity of 28.83%. CISCO is sitting on about $30 billion of cash, and they have a great current ratio of 1.59. Analysts do rate CISCO as a 2.4, meaning it is between a buy and a hold, and the average analyst price target is $48.74, which is about 6% higher than the current price of $45.43. In my opinion, there are quite a few positives with CISCO at the moment. First, they have a strong balance sheet and their cash flow from operations is solid. CISCO was supposed to acquire Acacia in July 2019, and after a long time, they finally confirmed a merger will take place. This is going to be about a $4.5 billion deal, so basically they'll be buying at $115 per share, which is much higher than what they had originally planned. Hopefully this will help CISCO gain some momentum and offset its slow growth. CISCO's annual dividend payout is $1.44, which equates to a 3.19% yield. And its 5-year dividend growth is 11.76%, which is absolutely great. I'm a long-term believer in CISCO, and while they are definitely not an exciting company, I do think that the recent announcement of the merger will give them some revitalization. Overall, I'm holding onto my CISCO stock for its solid dividend and proven track record. Number 5 on my list is Verizon, stock ticker VZ. Verizon is one of the biggest telecommunications companies in the United States. Right now, Verizon is trading at $57.38 with a 52-week low of $48.84 and a 52-week high of $61.95. The stock really is bouncing all over the place, and we can see that they recently reached their 1-year high, but since then it's down a little bit. Verizon has a market cap of $237.44 billion, a PE ratio of 12.98, and a dividend yield of 4.4%. They have a 5-year PEG ratio of 3.73 and a price to book ratio of 3.72. They have a pretty strong profit margin of 14.26% and a very good return on equity of 29.72%. They're sitting on about $9 billion of cash, and their current ratio is 1.07. Now, analysts are rating Verizon as a 2.6, meaning it is between a buy and a hold. And the average analyst price target is $61.62, which is about 7% higher than the current price of $57.38. Overall, I do think that Verizon has excellent potential in the future. In the most recent news, Verizon should see significant growth in their service revenue segment due to the TracFone acquisition. And them going all in on 5G is something that I really like to see. If you've seen any of my other videos, you'll know that I really am a big fan of 5G technology. Verizon has had some bad acquisitions in the past, but I like how focused Verizon is now on its 5G service. In the last year, they spent about $14 billion on capital expenditures, and this was all to roll out its 5G network. They generated about $18 billion in free cash flow in the first 3 quarters of 2020, and soon we will see their next earnings report, which comes out on January 26. Now, in those 3 quarters, they spent about $7.6 billion on dividend payouts. This was the 14th consecutive annual increase in Verizon's dividend, which goes to show just how reliable their cash flow is. Paying out $2.51 a share means a dividend yield of 4.4%, which, although is not as high as some others on this list, is still pretty great in my opinion. Definitely keep an eye out for the 5G wireless auctions, as the big players are bidding for 5G wireless spectrum and spending billions and billions of dollars. The FCC's auction of mid-band or C-band airwaves has resulted in huge upbids, and it seems like Verizon is set to spend the most money, followed by AT&T. This will definitely hit Verizon's balance sheet over the next decade, but I don't see it hitting the dividend. Overall, I am just a big fan of Verizon, and I think that it is a safe stock that investors love for the added bonus of its relatively good dividend. Okay, so those were 5 interesting dividend stock picks that I encourage you guys to check out. I'm not a financial advisor, and I urge everyone that invests to make sure to do your own due diligence. Simply use this video as a guide to kickstart your own research, and definitely don't buy a stock just because I had it in this video. You want to do your own research and make your own decisions when it comes to investing your money. If you guys have not yet already, make sure and get your 2 free stocks from WeBull when you deposit $100 or more into your account. This is a great stock trading platform, and if you're starting out, you might as well get some free stocks. And also subscribe to see more videos just like this. I make a ton of videos about personal finance, investing, and entrepreneurship. Thanks so much again, and I'll see you guys in the next video. Peace.